Hello everyone, my name is Benjamin. Welcome to my channel. For those of you who know me, I'm the Buffett investor. So today we are going to do something a bit different, as you can see. Actually today I'm here with my company to clean up the rubbish on the beach, and it is part of our efforts to drive sustainable, creating a sustainable environment, right? And so in today's video, just thinking, since we're all touching on the topic of sustainable environment, I thought, hey, wow, actually this also can be a very interesting topic, applying to the way how we do our investment, right? And sometimes, people, we only tend to go for the short-term gains and short-term returns, right? But that also causes a lot of sleepless nights and a lot of panic, anxieties, right, when the market is not doing well. And so instead, I would like to encourage everyone on how we can actually invest our money or our portfolio in terms of our wealth for the sustainable long run, right? It's about how we can create consistent and sustainable returns. And of course, one person that I always admire and how we can look to is Mr. Warren Buffett, right? In terms of the way how he look at companies, is that we can always think of it as a business. And does this business really have a lot of strong economic moat or a competitive advantage that put itself ahead of its competitors, right? And that it also increases the barrier to entry. So of course, I give you one example, like Apple, right? As a company, they are not just selling electronics, but really at the heart of it, they are really selling a very strong brand name, a very strong brand identity that people can associate with, right? And that really creates a lot of goodwill around the company. And of course, just using Apple as an example, when we look at strong companies, some of the good things we can look at is in terms of its very strong earning power, right? So if you go and visit some of the financial sites like, Morningstar.com or Yahoo Finance, it's always good to take a look in terms of the past years of financial numbers. Does the company, is it growing in terms of its revenue, in terms of its profit margins, right? Things like that, right? We can also look at in terms of the earning per share. Do you see a strong positive growing trend in terms of the earnings per share, right? So that's one portion. Of course, then some other things we look at is also in terms of the growth rates, right? We always want to see positive growth rates in terms of revenue, right? In terms of earnings per share, as I mentioned, and of course things like that. Another thing we want to look at is for a company to remain sustainable, healthy, right? They also, I would strongly recommend that we choose company with very low debt ratio, right? And debt to earnings ratio. So if you look at it, normally we want it to be at least 0.5 and below. Why? Reason being is that also, of course, in good times, fine, companies can operate, but normally it's during bad times where company might experience problems in its cash flow. And if a company is very diligent and prudent in its spending and taking on very, as little leverage or financial debt, then probably during the tough times or during a recession downturn, the company has a larger cash flow to ride out the storm and the financial crisis, right? So those are some of the things and how we can actually look to invest in a company sustainably. And of course, as investors ourselves, it's also important when we invest in a market, try, in terms of a timeline, I always say, think of it as if the market were to close down over the next 10 years, are you comfortable to park your investments, right, in the stock market? So for you to have that confidence to put away the investment for 10 years, it also means that before we even want to buy a stock, right, we do not want to listen to hearsay or to your uncle, auntie or man on the street, right? We really want to do our due diligence and to go on to those websites that I've shared earlier on and to check out the numbers, right? The numbers will not lie, right? And that is very important. I always stress to my to the people out there before they make a very strong investment, because investment is actually very high, it can be quite high risk, but if we do the due diligence, we are able to do the risk management and to lower down the risk, right? So I hope in this video today, right, I have already shared with you, you have benefited from in terms of what are the things that you can look at to evaluate a company and how to invest. Most importantly is actually how to invest for the long term and to have consistent and sustainable results. So I'll see you soon and stay tuned for the next video.